Before we get started, by a quick show of hands, please raise your hand and keep your hand up if you have been a customer of one of the following companies: Uber, Square, Dropcam, Twitch, Rovio, I'll hurry so that your arms don't get tired, Credit Karma, Fitbit, Canvas, Automatic, Peloton. If you look around and you see kind of the impact made by this set of companies I just listed, made possible, all of those made possible by initial investments made by folks on this stage. So talk about creating impact. Pretty amazing. What you may not know about the panel are some of the following quick facts. Aydin, on my far right over here, is, and I quote, obsessed with reading about the Navy SEALs. So look forward to hearing about how that translates in terms of how you select investments. Rob opened a CrossFit gym, I think 8 years ago, before CrossFit was at all popular. So great foresight there. And Phil, I have to ask, Mr. Velvet is the Twitter handle. Let's hear a little bit about that.
So the cost of me coming to is I get to ask everyone to follow me at Mr. Velvet on Twitter. It's a wonderful way that all folks can follow. It was from my partner Om Malik, who said that I was a venture capitalist who kind of liked behind the velvet rope. So like this would qualify as a velvet rope event. Right. And then my other partner Tony Conrad, when Twitter first came out, he said, "Great news, I got your handle for you." And he said, I opted not to go with that Mr. Velvet rope because he thought that would be some kind of BDSM kind of affiliation. So. He just went with that Mr. Velvet. And it kind of has stuck, and it was kind of a joke in the very beginning, and now, you know, all of my thousands of followers would be so upset if I had to change, I think. So
well, you can't change.
Yeah, no, exactly. So yeah. I just stayed.
Well, thank you for the context. So we'll dive right in, and we'll do a combination of some questions today, and then also I'll invite you to participate with your questions. So in terms of you look across the panel, I'm sure you see thousands of deals a year. What are determining factors when you decide to make an investment? Rob, should we start with you?
I mean, so, you know, we're investing at first round super early, right? So it's like, I say, like two coders and a dog type of companies, right? And so, you know, there's an idea, there's a market that they're going after, and there's the team itself. And you know, you get you know, we'll spend a lot of time on the team, with the team, getting to know them, getting to know people who know them, and just trying everything we can to learn about them. We spend a lot of time on the idea. Do we think that they're starting with a real problem? So if you're someone that's like right now, I've seen in the last, you know, month probably 10 different companies that have bots somewhere in their description, and I see all these companies that are going after bots, and they're starting with bots and then figuring out what they can do with bots. And I like to work with companies and teams that are starting with a problem and figuring out the best way to solve that problem. And if a bot happens to be a component of that, great. But if it doesn't, I really don't care. And then looking for companies that have markets that you can expand into. I think that market size is the easiest place to have false precision.
Right.
But you also, if someone's going after, I mean, you know, I'm wearing my Stance socks. I would have thought that, you know, the sock market, you know, if you initially told me wasn't a good venture investment, but obviously for a lot of people it's a great venture investment. So, you know, that's where I think that traditionally you wouldn't see venture capitalists investing in stocks, but today you see them investing in stocks because they think different things about markets.
Right.
And I would add to that, I think we are a little bit more stage balanced, but we have some interesting aspects that I think is applicable universally. One, we really want to see the founders being able to articulate their success and what's going to make them special, and then to be able to also articulate the path to success in the back of a napkin. Like we have a company in Australia. First time we met, like the founder basically said, look, here's the product. You know, I have roughly a 10,000 price. When I have 10,000 customers, I'll be at 100 million revenues. Right now I'm at like close to, a couple hundred customers. I'll be at like north of 1,000. So that's a very clear way. Like it's very, very precise. So we really like that. The second thing we look for that is unusual is lack of competition. There's a lot of ideas, and I think competition is one of the unfortunate ways to erode value. And the third thing is what we call kind of team completeness, and this is not like, oh, you have every position filled. It's more like there's a product mind, there's a technical mind, and there's a commercial mind. Sometimes some of these can both be in the same, or three can be in the same person, but are all these skills like properly present in the team with the right experience?
So I know we don't all need to answer the same question, but this one actually there is some differences in terms of kind of what people look for. So for us, internally I have this little picture that when it's three circles and they're kind of very small overlap of all three, and I put a little T favecon in the middle, and it looks like Mickey Mouse. And so I have this, I'm known for the person who kind of always brings up this idea of is it kind of fit the Mickey profile for us for what we're doing. And which is kind of funny that a venture firm would actually kind of follow Disney characters, but nonetheless, it works for us. And the three things are, it's the founders, it's the market, and it's the quantitative aspect of the investment, the deal part. And so, when we get involved, it's a seed or early A round. There's 1 to 4 founders, 0 to 5, maybe 0 to 10 some odd employees. And they're going after a market that is probably not actually in business right now. I mean, it's a nascent market. It's one in the future, hopefully not too far in the future. And it is one that we talk about as being kind of more blue ocean versus red ocean. And so the blue ocean is very pristine and it's wonderful, and you kind of don't have competition. The entrance of your company to that market actually expands it, and your success is not dependent upon the demise of someone else, which would be more of a characteristic of that red ocean. So we try to stay away from the red ocean markets as best as we can. And then the third part is the quantitative part. We have a business model as well. We are an investor, but we have limited partners that we have raised capital from, based upon the premise that we're going to be that first check of somewhere between $500,000 to $2.5, $3 million some odd dollars, and that we will be the significant minority investor partner with those founders. And this is a 5 to 9 year kind of commitment on our part. I mean, if this thing works, you're going to play it out over. It literally will take somewhere between 5 and 9 years. And so having a large ownership stake is consistent with being the strong financial partner for them in the very beginning.
You all have touched on market and founders, but I'd be curious to hear, are there characteristics of what you would say are must fund in certain founders, and if so, what are they?
I'll take a shot at it. I think, look, there are two things that I think time and time again that I found not being stressed, and that is, I think the founder, building on ability to articulate success, also needs to be charismatic, and is very important. So it's not just for investors, but more importantly, to be able to attract talent to your company. I think we all realize and know how difficult it is to build teams, especially in this environment, especially in a place like Bay Area. I think the second thing is ability to network with people. Like, I think majority of, especially earlier or first-time founders that I met, are very capable technically, have fascinating ideas, but don't understand that networking and knowing people is like job number one. It's important for hiring. It's important to get customers. It's important, for investors and other stuff. So I would say those are key qualities to kind of supplement kind of the product vision as well as the technical ability to build a great product.
Yeah, and one of the things that I really look for is someone that they can, I call it, run up and down the stack of being a CEO, right? And so Nick Weaver at Eero can tell a great story about Eero. He can talk about the kind of home networking market. He can explain why his product is going to change the market, and the same in the next breath he can go down and talk about why the shielding on this radio needs to move 5 microns over because it's interfering with something else. And he understands everything that's going on in his company. It doesn't mean he's getting involved, doesn't mean that he's like micromanaging anybody, but he can answer anybody's question, and that gives his team confidence, that gives his investors confidence, and that frankly leads to the confidence that they show as they enter the market.
Right.
Look, I think founders are the key. It really is, for us, it is the founders and market are kind of equal weight. And I think you kind of know it when you see it in the room. And there's something about that founder who is able to tell the story and to convey the vision, because they're literally trying to make something from nothing, and that's very hard to do, and it's going to take a lot of years. And so, just because he was up here literally 30 minutes ago, Brian Wong is someone who we invested in. How many years ago would that have been? That would have certainly been like 2010 or something like that. So 5-6 years, and he has made something from nothing, and it is. I mean, he's infectious. He's probably gone by now because he's. Oh, he's over there. Okay, good. But like, I was in the room with him. I'm like, I get it. I'm like, and he has boundless energy, and so it's the founders have to create this jigsaw puzzle of a management team and an organization. And so whatever they don't have or they need to add, and will people want to join this person on their journey? And that is the really most important element for us as we think about it.
Yeah. Brian's a great example, right?
Yeah.
And does True per se have mobile, like an investment thesis specifically for mobile?
Not specifically for mobile. I mean, I think the mobile was its own category there for a while, and now it just kind of feels like it's table stakes for a whole host of major categories within the technology world. So clearly, a lot of the companies that we touch on have a mobile element to their product roadmap, or it is their product, but it's not so much that we have dedicated people in that area.
Right. And what about both of your firms?
I think for us, we have two theses. I guess we're blue ocean and red ocean. We have the reinvention team and the frontier team, but one of the areas that we're very excited about is consumerization of enterprise. And so I think there are going to be like fantastic companies created that are just running on like mobile phones and iPads and tablets that are vertical specific, where they're either replacing Microsoft Excel or pen and paper. And I think that's very interesting. I think new industries will be created based on that. So with specifically mobile, there are so many other areas, but we feel that's kind of one that it's tremendous potential.
Yeah, and just to build on that a little bit, Aydin, with the proliferation of mobile within consumer, where are we with mobile, kind of mobile first across the enterprise?
I think enterprise is very interesting because consumer, I mean, we mentioned Rovio, so we went all the way from, gaming and communication was and news were the first three kind of categories. WhatsApp got acquired by Facebook. Gaming, it wasn't, Rovio, but like their neighbors in Finland, Supercell, ended up being very successful. In news, there was like Pulse got acquired by LinkedIn. Then there was like second kind of category apps like in fitness, but there the winner was companies like Fitbit that combined it with hardware. That's why I feel like right now, enterprise is very interesting. Like I just heard of a company that is in Santa Barbara that has like well into 9-digit revenues that nobody else knows about, that, for instance, Apple is using for its new campus. And I think what really gets me excited is these new champions that have very significant revenues that are in random cities that people don't expect, that are going to create these kind of multi-hundred, if not multi-billion-dollar businesses based solely on mobile. And the time is now, because that was not possible 10 years ago. Now there is enough penetration in mobile. People have a way of using mobile phones, and they expect a lot of consumer apps have caught up, but enterprise have not caught up. And you cannot rebuild these companies. Like eBay was built 20 years ago. It was not built with today's technology. So these companies have a very big difficulty to reinvent themselves. That's one of the reasons why we feel comfortable attacking, especially in this area, red ocean, because we feel the incumbents don't necessarily have the right attitude or the fundamentals to go after this market. So we think it's a very interesting time for this.
Yeah, agreed. Rob, the landscape has changed a lot since the beginning of the year in terms of just the current markets and the environment. How have you seen that impact investing overall?
Well, I mean, I think the thing that's really changed is you're seeing a rationalization in the kind of exit environment, and so companies are sitting on these massive valuations, and you see this, and all of a sudden, it's funny how it happens all at once, but everybody's like, wait a minute, there haven't been any exits in a long, long time, and they're not as good as they were, and
Right.
companies are seeing down rounds or exiting for less than their last 2 rounds of financing, and so what happens is you had an environment kind of for me anyway, you had an environment a year ago where you had people looking around and saying, hey, my friend just started a company, my other friend started a company, maybe I should start a company. And there's all this money floating around, and everybody's doing a safe with a 10 cap or a 12 cap or whatever. And today what I'm seeing is that it's kind of only, you're getting back to the point that I really enjoy, which is only the batshit crazy founders are starting something right now because it's harder to do.
Right.
And you actually have to have a good idea, and you may not get the valuation that you want. And so you're seeing a rationalization of the prices. You're seeing fewer companies get started, and you're seeing in our community of companies, you're seeing people begin to think about unit economics a little more, about getting to profitability, about shifting the levers of growth versus profitability.
Right. What about you? What have you seen?
So I'm right in the middle of writing our quarterly letter, and so one of the things we do is kind of take a look back, and I make the statement that literally beginning in December of 2015 is when the financing market changed fairly dramatically. Mm-hmm. And so it's been kind of in a state of flux since that period of time. I would say that capital is a little bit more difficult to get at all the levels, but it's certainly hardest at that kind of the later stage, high valuation numbers. And I think there's 4 major risk categories within the venture world, which is market, product, execution, and financing risk. And for a long time, no one has really factored into the equation financing risk. And that's now kind of, there is no financing risk until it's right there staring you in the face. And I think it's staring a lot of people in the face. And it's particularly difficult for folks when, as Rob mentioned, if you've got a bad unit economics business, you don't make it up in volume. But there was kind of this meme going around, I think, where it's like, oh, if it's a billion of something is worth a lot. And it's like, well, it's not if it's not a profitable business at the end of the day. And so I think the examination of where is the money coming from, how much do you actually make, what kind of value you actually giving, mm-hmm. Those things are becoming very relevant to whether a round gets done and certainly the kind of the price that happens.
So with that, I'd love to open it up. Or anybody have any questions for the panel? Not one question?
While people are thinking, let me add another perspective. I mean, I think that is kind of the state of the industry, but the other interesting thing that we're seeing, 10 years ago when I started in this business, like almost everything that I've done was consumer internet, maybe with a little bit of mobile, mm-hmm. hardly any enterprise. It wasn't even sexy back then. Now we're seeing companies that are trying to do crazy batshit stuff in like agriculture, in food, gene sequencing, transportation, logistics, government. You're like, who the hell would be interested in government? But you'd be surprised. And so I think the optimistic side of things is technology used to be like 1.5 sectors. Now I feel like 10 to 20 sectors. And a lot of times I think like in venture capital, I think it was, a partner from Benchmark who said, look, the biggest successes is not when you're like optimizing for the risk, but when things go wildly right. And so I think sometimes because we manage LP capital, like we have this risk averse nature, but on the other hand is this crazy balance of like also being able to like take some of these crazy ideas and like figure out like how things can go wildly right, like as it happened in Fitbit, and like people didn't appreciate it until it became like really in front of their eyes. But for the entrepreneurs and the founders in the audience, I do think that it's exciting times, but I will also tell you that the bar is higher. Just because there's a great market doesn't mean that the right solution needs to be a lot more than just incremental, just for food for thought.
Anybody have anything for the panel? Yes.
So first of all, I want to say 15 years of venture investing experience. Yesterday, when this meme started making the rounds, was the first time I'd heard the term blue flame. So I think someone's yanking somebody's chain. Listen. There's a reality that sometimes people that come from not within a market or not within a certain sector, coming into that sector and thinking differently, can actually have a very, very large impact. Someone who's 20 years old and just coming into out of college, or maybe not even out of, maybe still in college, is by definition that person. But there's also there's a tremendous amount of benefit of having been through it once or twice or 3 times, just to know at least to be able to take all the mistakes that you've seen happen or that you've made yourself off the table when you're starting a company. And I think I don't have the source, but I've seen numerous studies that suggest that the largest number of really, really good entrepreneurs come in the 45 to 55 age bracket, as opposed to the very early kind of mythical age bracket that we tend to glamorize here in the tech industry.
I want to also combine your question with Rob's comments with the very first question we were trying to answer about founders. I do think that one of the qualities that make great founders, that create some of these really special companies, is people that are true rebels and think truly out of the box. I don't think, copying something that has already been done or copying a formula that already exists creates for those wild successes. And the reason why I'm making that is I think there is a misconception, because there is a big overlap of those people with people that are relatively young. All of a sudden, everybody thinks, oh, if you're young, you're going to be automatically in that camp. But we have so many founders that, for instance, Rob and I backed a founder, Jack Welder in New York. He was a retired Air Force pilot, and he's a founder in his 40s. And he's just as successful, widely successful, compared to people that are less than half his age. So I don't think you can make that generalization. Obviously, there are also examples like Brian from Keep, but I think you can really literally see the success. People get that fire. It could be any time in their lives. I wouldn't be surprised if we see some amazing entrepreneurs still in their 50s that have this passion and fire to make a difference. A lot of times when they become missionary, when there's a cause, that's kind of age independent, that they really go out there and I'm going to dedicate my life to fixing this problem. Jeff Huber is a good example. I mean, it's sad. His wife just died from cancer. He's now CEO of Grail. He was at Google. He's I'm going to dedicate the rest of my life curing cancer. Good luck competing with him.
Very true. So what's the one piece of advice that you'd give to CEOs out there that are contemplating raising a round right now? How about you, Phil?
Oh, well, I would say it absolutely starts with authenticity and transparency. I mean, it's because if it's not something that you truly believe and that you're, and if you're just kind of putting the proverbial lipstick on a pig, it just won't work. So, you just have to be authentic. And I always kind of view the discussion that we have with our founders and entrepreneurs in general is it's more of a collaborative, let's just talk about what the issues are. And so I don't really like the idea that I'm being sold something. I think that's easier to have a more collaborative effort when there are ideas and kind of possibilities versus an existing business that's kind of been doing it for a while, and this is why we've done it. And so that's kind of easier for us on the new funding front.
So I get asked this question all the time by people that are thinking of starting companies, and they say, so what should I do if I want to start a company? And I go, well, first of all, you shouldn't start with, I want to start a company, right? And so, because I see that all too often where a group of, two people get together and say, we should start a company. Well, what should we do? Well, I don't know. And so they sit down and they go through this random business school exercise of, well, let's look at these markets, and this one's a big one, and what's going on in that market? Well, there's these problems we can solve, and maybe we can solve that, and I know this person that can do this, and I'm like, okay, hold on. So until you have a problem that you cannot go to bed at night not thinking about, and you don't wake up in the middle of the night 10 times thinking about and can't wait to get out of bed and solve that problem for somebody and get people around you and know that this is what you want to work on for the next 10, 15, 20 years, don't start a company, right? If you think you're going to start a company because you're going to make money, that's the stupidest reason to start a company. The chances are you will not make any money, right? And so you need to do it because it's something that you want to do and you want to commit to, and that you are going to put other people's money and time and careers and everything on the line because you believe so much. And short of that, it's like, go work at Google.
Yeah.
I would add two things. One is, look, I think it's very important. All the greatest companies created, contrary to popular belief, is based on one simple idea. So I think both Phil and Rob touched on it, but we have this concept called the narrative. That's what I was kind of trying to touch with Charisma, is that the most successful founders don't just have a great solution, but also have a great story around it. Storytelling, I think, is a very, very difficult thing to get good at. I think it's imperative. So you need to have a 30-second pitch where it captures somebody's imagination. The second thing is, I think it's also very important to visualize success at scale, to be able to reverse engineer it and to be able to demonstrate it on the back of a napkin. Now, if you have a plan, the plan can change, but if you don't have a plan, having no plan is the plan to fail. So I think you need to visualize success, and you need to have a very simple strategy of X, Y, and Z dynamics, those that matter for the business, where do they need to be at scale, and reverse engineer and say, this is how I'm going to realize this incredible vision of a product or company that I have to get there. And being able to do that very simply without like going back to the deck or spreadsheets, I'm like, look, turn off the computer. Just show it to me in the back of a napkin. Do you understand the metrics of your business? Do you understand what you're going to need to succeed? And can you articulate it very quickly, kind of like on the table with just pen and paper?
Okay. Well, I think that's it in terms of time. Thank you very, very much to all of the panelists today. And we will turn it over. I think it was great.
Awesome.